factors are aligning. Economic and financial indicators are signaling. Experts are warning that an epic stock market crash is near. At this moment, the S&P 500 and the Dow are at all-time highs despite the huge sell-off that happened on Tuesday. The Nasdaq is also close to record levels, and all three indexes went up between 14% and 18% just this year. It's when the market hits its peak that things start to crumble, and September, historically known as the worst month for stocks, is right at the corner. Right after that comes October, which is remarkably known for the devastating stock market crashes in 1929, 1987, 2008, and most recently, 2018. And if you haven't noticed yet, there is a series of determinants weighing upon Wall Street and worrying investors right now. The worsening of the health crisis due to the emergence and fast spread of the Delta variant is one of them, along with concerns about the alarming growth of inflation and how the Federal Reserve will handle it. On top of all that, chaos is looming all over the world, with rising threats of civil disorder and social conflicts. All of these factors are adding major pressure to the markets and putting the market's bull run at risk of derailing. That's why investors have been increasingly scared that stocks may soon experience a sizable crash from recent highs. Stocks haven't faced a reckoning since the first round of lockdowns in March 2020, which resulted in a brief bear market and triggered a 20% crash from prior peak levels. But many are still ignoring the fact that the Delta variant could lead to another wave of mass shutdowns and push the economy into another recession. That's partly due to the fact that millions of Americans already got the vaccine, and after almost 1 year of frequent disruptions, businesses are unwilling to hold operations again. As a consequence, investors may not be able to predict how deep the slump would be caused by any Delta-induced slowdowns. Now that the boost in consumer demand has faded, the economy might not be as resilient to another collapse. Consumers and businesses have already purchased PCs, networking equipment, software, automobiles, houses, and other durable goods, and would not need to buy more. As explained by John Weil, Chief Global Strategist with Nikko Asset Management. Thus, he says, the economy would not rebound sharply. In this case, it would be best to wait for a major correction, he added. Overvalued stocks and an unrealistic economic outlook are setting the stage for what could be the worst financial catastrophe of the century. According to Ipek Oskardeskaya, the senior analyst at Swissquote, the cliff between the economic indicators and the equity prices is somewhat unreasonable, hinting that there is potential for a sizable downside correction. Of course, when big names of the financial world are talking about a looming disaster, oftentimes they fear using that word crash, not to spook volatile investors, but we all know what they're talking about. But the situation looks so dire that even Morgan Stanley chief U.S. equity strategist has been sounding the alarm for stocks. Mike Wilson, who's also the firm's chief investment strategist, doesn't see much upside left for the S&P 500 for the remainder of 2021. Morgan Stanley's year-end price target for the benchmark index is 4,000. That's a nearly 10% drop from current levels. Moreover, Morgan Stanley forecasts that a so-called correction, at the very least 10%, can occur anytime from now to the end of the year. The combination of lower the consensus earnings next year and lower valuation leads us to believe that there's very little upside, if any, to major U.S. equity indices over the next few quarters, said Wilson. The strategist also expects the corporate tax rate to increase after the $1 trillion infrastructure bill is approved in Washington. Another determinant that could weigh on stock valuations is the Fed's reduction of its asset purchase program. Now, all of these negative factors could leave the S&P 500 vulnerable to a crash. And when it happens, it's gonna be so brutal, many won't have time to run for the exits. That's what short seller Jim Chanos warned in a recent interview, highlighting that retail investors late in the game could be left holding the bag as more red flags emerged in a speculative stock market. Chanos is a famous short seller on Wall Street who's known for his unique ability to identify fraud. He's also known for betting against the energy trading company Enron in 2000 after discovering a series of deceptive accounting practices. Now, he's cautioning retail investors that big firms might be scamming them by not telling the truth about risks and potential losses. The historic rally that started last year has attracted a record number of new retail investors entering the market for the first time. Many of them were allured by social media trends and ended up in the most volatile and riskiest areas of the market for outsized short-term returns, including shares of companies with decaying businesses like AMC and, GameStop.
American workers have been tested like never before.